everyone. Welcome back to another podcast with Mr. Hagan. On this podcast, we're going to pull the short aggregate supply curve and the aggregate demand curve together onto one model, and we're going to be thinking about the world now a little bit more from a Keynesian point of view, because we're going to be focusing on the short run, and in the short run we're going to find that a nominal variable on the vertical axis, price level, can affect a real variable on the horizontal axis, real gross domestic product. So that's going to violate the classical dichotomy monetary neutrality principle, and that's much more of a Keynesian kind of argument. So let's get right into it with a real world event. Let's say that my real world event is that we get a 50% decline. That's pretty significant. A 50% decline in stock prices, a 50% decline in stock prices, a 50% decline in the stock market. And so then I got to figure out which determinant is going to change as a result. And so I'd have to work my way through my short aggregate supply determinants. I'd have to work my way through my aggregate demand determinants. And I would say, after looking at both of those, I would say the determinant that has changed is a change in consumption wealth. Okay, so this is a change in wealth that goes under the spending category of or a component of consumption. And so as a result of that, consumption, because wealth has declined, people are going to be less wealthy, and therefore they're going to buy less stuff, and consumption's going to fall. That means that the aggregate demand curve is going to shift in to the left. The aggregate demand curve is going to shift in to the left. And so we go record that over here. Aggregate demand curve has shifted into the left. Now, down here, I want to kind of tell my stories. I want to tell some stories down here to kind of explain how things are working. And actually, let me just move this up a little bit. I'm not sure if some of that wording is above that or was on top of that. So there we go. Hopefully that you can see that. The aggregate demand story is going to be that wealth went down, and the decrease in wealth caused a decrease in consumption. That was the aggregate demand story. That explains why people are going to buy less stuff. That explains why people are going to buy less stuff, because of the decrease in wealth. So if wealth goes down, consumption's going to go down. Now, if consumption goes down, that means we're going to move here along the short run aggregate supply curve. So what does that mean? That means as consumption goes down, people buy less stuff, and as they buy less stuff, the price of goods and services are going to begin to fall. The price of goods and services are going to begin to fall. As the price of goods and services begin to fall, that's then going to match us up here with the aggregate supply story on the short run. As prices begin to fall, so this is going to be, our story here is actually going to be sticky wages. It's going to be sticky wages. So if we get a decrease here in the gross domestic product, really two things have to be decreasing here at the same time. There's got to be a decrease in spending. That's going to happen on the demand side. And there's got to be also a matching decrease in production, and that's going to happen on the supply side. So what happens on the spending side is wealth went down, so people engage in less consumption. That's less spending, and that causes prices to begin to fall. Now, because of sticky wages, okay, remember this. Remember the formula that we did on the previous video. Your real wages are equal to your nominal wages divided by the price index. And now, because consumers are buying less stuff, prices are beginning to fall in society. And remember, we're going to argue from a Keynesian point of view that wages are sticky. So these wages, the nominal wages, are not going to adjust, at least not right away. Maybe because of contracts or whatever the case might be, these nominal wages don't adjust right away. So as prices go down, real wages are going to go up. And as real wages go up, companies will respond to that. So here we had decreased prices, that causes increased real wages, and then companies will respond to that by hiring fewer workers and therefore cutting production. So companies respond to the higher real wages by firing some workers and that will decrease production, and so as a result, production will go down. So we have our, through the aggregate demand story was a shift, and then short run aggregate supply curve, we have the story of moving along the curve, where a nominal variable has affected a real variable. And then we record finally over here what happens by the end is this will cause a decrease in the price level, an increase in the gross domestic, I just said that wrong, a decrease in the gross domestic product. I was just getting ahead of myself. A decrease in the gross domestic product. And remember, unemployment will go in the opposite direction. So if gross domestic product is going to fall, that means that unemployment is going to rise. And then the key to all of this is now here we are. We're just kind of stuck at this equilibrium, which is below potentially our long run potential. Okay, and then that becomes the problem. So this is the way we think about these models. We take a real world event, we match it up with the determinant, we shift the curve, we tell what happens to the three variables, price level, gross domestic product, and unemployment, and then finally, we got to tell the stories behind what is going on the curves. So we got to tell the stories behind what is going on the curves. All right, so thanks for joining me. This has been Mr. Hagan, another podcast. We will do a bunch of these on future podcasts. Thanks for joining me, and I'll see you on those future podcasts.